Professor Kim Ward, I would like to present Professor Kim Ward. He's professor of London Business School. He was awarded with the J. Forrest Prize. He was president of System Dynamics Society in 2013. It's an honor to have you here, Professor Kim Ward. Can you hear me?
I can hear you. Can you hear me?
Yes, we can hear you. Thank you for making this presentation for us today. It's an honor to have you here. Yes, we have the image of your screen. We can see you. It's okay. Is it?
I hope it's the right screen you're seeing. It should be the one with my logo at the top left and saying Agile SD.
Okay. Well, thank you for being with us.
I'm just checking that you're seeing the correct screen.
Yes, Kim, it's the right screen. It's your title screen with your logo in the top left.
Excellent. Okay. So, ready to start?
Anytime you want.
Okay. Well, hello everyone, and it's very good to be with you this afternoon. I guess it's not quite afternoon for you, but it's getting dark over here in the UK and getting rather cold as well. Thanks for the opportunity to talk to you on this topic today, what I'm calling Agile SD, or Agile System Dynamics. And the background to this is that I got rather unhappy with the standard process of building system dynamics models, so I tried to look at how it was typically done. Interestingly, it's not all that easy to find a definitive explanation for exactly what process you should go through to build a model, but if you read the books and read the way in which people describe the projects that they do, it sounds as though it goes something like this. We start on step one with defining the problem, identifying the problem's scope and boundaries, the main variables and the reference node chart for behavior we're trying to understand. We then go on and develop a causal loop diagram seeking the cause-effect relationships in the system, focusing very much on trying to find the feedback loops that may be operating in the situation we're trying to understand. We then need some clever people to help figure out what the stocks and flows are in that causal loop diagram, so that we can throw the model over the wall to even more clever people who can help turn that into a working numerical model. To do that, they've got to go and look for a lot of data, build the software model, formulate all the relationships among the elements in the model. And then we have to go through a process of validating and testing the model, ensuring that it reflects the problem situation correctly and behaves right. When we've done all that, we've got a useful model that we can use to explore scenarios, test policy options, and all the other good things that we want to do with models. Now, the first part of that process mostly seems to be qualitative from what I can see about how people report on what they've done. No numbers enter the discussion pretty much at all after the first reference node chart, which may have some numbers on it. The process involves consulting widely, sometimes very widely indeed, very large, diverse groups of people. And what we're trying to do in that stage is get a kind of whole system scope, a shared mental model of the big picture that we're trying to understand. There are variations on this process. Some favour a rather more better specified version of this called influence diagramming. Some consultants I've worked with use stocks and flows from the start, but they put them on the diagrams qualitatively also. And there's another approach called the modular approach. There are probably others. But talking to the people who we do this work for, and listening to some of the pushback we get the following principal pieces of feedback. The first is that this process just takes too long. It takes months and months to get through all this. It costs far too much, both in terms of time and money. And the benefits we get out of it are very uncertain until really quite late on in the process. You might get some broad directional suggestions in the earlier part of the process, but we can't really figure out much about what to do until late on. And a further big problem is that only experts can do it. You can't take even a master's student out of our programs and expect them to do this, because there's an awful lot of wisdom required in that top left corner, and an awful lot of kind of senior level consulting and process management skill, which young professionals have got no experience of, so they just find this difficult. So is there what I'm calling Agile Alternative? I think there is, if you go back and actually follow the generic principles, if you like, the theory of our method. And we start by, in the same place, what we're trying to do is explain and improve performance over time. That's okay. We're starting with the same chart. The second principle, though, is that performance depends at every point in time on the level of the stocks, of some of the stocks in the system. I'll demonstrate what I mean by this in a moment. The third principle of our method is that those resource stocks accumulate, and those accumulations are driven by flow rates. So the last thing we want to explain is the flow rates, and those are driven by the decisions that we make, like hiring or adding capacity, by external factors like competition and customer demand, and by existing stocks. And it's because existing stocks drive flow rates that we get feedback. You can't have feedback unless that last statement is true. So, so if we follow those principles, can that get us to a working model and a solution rather faster? So I'm going to take you through the simplest possible case that I've come across in using this method. This was actually done by one of my executive students some years back, so I'm kind of relaying what they did. And it concerns a small IT support company, the kind of company that provides computer support and communication support for mid-sized companies. We're not talking about EDS or IBM here. We're talking about a relatively small company, a quite small company. So this is the conversation that the guy went through with the owner of this business. So, okay, you say, Mr. CEO, that customer problems are increasing and client numbers are falling, and this has developed over the last 2 years. Can you explain what's happened and sketch a chart of each item? So he gives the pen to the CEO, and the CEO, with my friend's guidance, draws the diagrams on the board on the right-hand side. And he says, 2 years ago we had about 90 clients, we were doing quite well, so took on a sales executive. He signed up more clients and we grew to about 135. But then we had reports of rising client problems, peaking at about 3 per month for every client. Staff have to fix those problems fast rather than do their normal job of client support. We've since lost some long-standing clients and we fear it will take time to cut the rate of problems. So the first part of each chart shows the last 24 months, and the last part of the chart in red shows what we fear will happen over the next 12 months. So that's principle one. What we're trying to do is improve performance over time. Performance here is fixing the problems and keeping the clients. Principle two is that stocks drive that performance. So, question to the CEO, what caused the increasing rate of client problems? Well, it looks like there was the pressure of work on our staff. We log the work they do, installing equipment and software and so on. That increased much more than our capacity to do the work. People were working into the night and at weekends. We estimate that workload could have been 60% more than people could do in a regular work week. So that's what's happened to the stocks. We already did the first stock with the clients at the top, and the second stock is to do with how many staff we have to do the work that the clients want. And there's the chart in the middle showing the work pressure that the staff are under because of the rising number of clients. Has anything else changed? No. Do you have problems with unskilled or unproductive staff? No. So we seem to have a complete explanation that part of the situation. Okay, so let's make a working model of this. That can't be too difficult. And here is the working model of exactly what we just put on the whiteboard. And the important point to notice is that users recognize everything here. There is nothing on that picture that they don't recognize, they can't see and feel and touch and at least estimate numbers, even if they don't know exactly what the numbers were. Now, as I unfold this story, there is a series of working models that you can go to, and each one is highlighted on the slide. But I'll share this with you afterwards, so if you don't catch the URLs, you can see them later. So now we know what's happened to the stocks, and we know that the only reason stocks can change is because flow rates make them change. So what caused the stocks to change like this? How fast have you been adding and losing clients? So my friend draws the flow arrows next to the stocks, gives the pen to the CEO and asks the CEO to sketch in the time charts of how many clients have been won, how many clients have been lost, what's happened to the hiring rate of staff and the loss rate of staff. And he says, well, yeah, the sales guy built the client win rate to about 7 per month, but he's really struggled to keep that going. Previously we hardly lost any clients, but now that loss rate has increased to a peak of 8, but we're losing fewer clients now, rather simply because we've got fewer left to lose. And on hiring and losses, we kept up our normal hiring rate of 2 people per month. Recently we've seen an increase in staff leaving, which we never really had previously towards that. So we've added the flows to the stocks. Okay, so let's extend the working model. There's the working model, and we've added the flows that match what the guy just drew on the board, and the flows explain the stocks and the stocks explain the problems. So what caused those flow rates? Now this is the critical piece of it and what really connects back to the feedback view of the situation. So there are 3 classes of things that drive the flow rates. The first thing is our decisions. So prices that we choose, hiring we choose to do. External factors like competition and existing stock. In this case, in some cases it's the product range, and we'll see what this is in a moment. In fact, we'll see that right now. In this case, the decisions involved are to take on the sales guy and to keep on the hiring. External factors aren't relevant. The issues here are entirely self-inflicted. And the existing stocks are the stocks of clients and staff that we've already got. So if we complete the picture, if we want to explain the loss rate of clients, why did clients leave at the top right? Well, they left after a delay because they had experienced problems caused by the work overload. Why did staff leave? Well, they left because of the work pressure. And we won't be surprised to discover that when you connect the flows back to the stocks, that's when you discover what the feedback loops in this situation are. We've got a balancing loop at the top, preventing the clients from growing, and we've got a reinforcing loop at the bottom, driving down our staff. So let's extend the working model and explore solutions. So one solution that we explored, we wired up here the link from the problems to the client loss rate at the top right, and we've wired up the link from pressure on staff to the number of staff lost. And this particular scenario on screen is a choice that we looked at and they did implement in part, which is actually to deliberately discontinue clients that they couldn't serve to take the pressure off the staff, meanwhile hiring further staff when the pressure is reduced. You don't hire more staff when they're already under pressure, because that just makes it worse. So that is that's the story. Not a very complicated story or a very long one. There is rather more to it, and there's a couple of links on this slide at the bottom left that show how we looked at the impact of intangibles, so staff morale and company reputation, And we've also shown how you can design policy for this thing so that you drive your client acquisition rate and your staff hiring rate, not just because you think it's a good idea, but by reference to performance indicators of the business. So you'd be looking at pressure on staff, you'd be looking at profitability to decide on your hiring and your client acquisition rates. So that, as I say, that's about the simplest example I can come up with for you on this. But we have used it for way more complicated cases than this. But all those complicated cases do is keep repeating those same steps. So what is this process? Well, we start in the same place, the problem definition and the time chart of reference mode, and we trace causality back to the main stocks driving those outcomes, and we quantify what's happened to those stocks. And just that one step alone already gives you a working model and actionable findings. You know, the CEO already knows more than he did when we sat down to start on this project. Then we do the same process of quantifying and charting changes over time to the flow rates that cause those changes in the stock, and that's capturing stock accumulation. And again, we've got a working model that generates actionable findings. And then we trace the causality back from each flow to the decisions, external factors, and existing stocks to identify interdependence. And now we've got a working model of the situation. Now, if that working model does not give you an adequate explanation of everything you want to know, what you have to do is go recycle around through steps 2, 3, and 4. Effectively, what happens there is that each flow rate in the model becomes a new dependent variable for which you are seeking the cause. And you know, sometimes you have to go around that loop 2 or 3 times, but you rarely have to go around it many more than that. But even that can generate quite large models, especially when you've got segments of customers and multiple groups of staff involved and that kind of thing. So I'm not suggesting here that we are kind of simplifying away all of the complexity of the business with this process. What we're trying to do is make the process as simple as it needs to be to deal with the problem. Now, there's an interesting observation on this, which is that the very first chart I showed, which I won't go back to, the process that's normally described, has an uncanny resemblance. It's almost a photocopy of a process in the software development world that used to be called waterfall, the waterfall model of software development. And I've tried this on a few people in the information systems world, and they confirm, you know, with some corrections of my ignorance of their world, that is what people used to do with waterfall software development. Describe the whole scope of what you're trying to do, design it all in principle on paper, or maybe on a computer, and only when you're pretty sure that you've got the whole structure of everything you're going to try and do you throw it over to people to try and start writing code. And that's effectively what we've been doing. And the software development world, they haven't totally abandoned the waterfall approach, but a very large proportion of software development methods now operate an agile process which has got exactly these kinds of features. You sit down with the user and get as fast as possible to something that kind of does what it is they want to do. And you draw a line there and say, okay, well, let's go on and try and extend that and make the next bit do a bit more of what you want to do. And all the time the client's getting something useful out of it and something working. So you're getting early benefits. So the benefits of this alternative seem to be you get early and frequent actionable insights. The people involved recognize everything they're doing all the way through because you're specifying and quantifying them as you go. The models are kind of self-validating. If the blue line doesn't match the red line, and the red line is real data and blue line is what the model says, then you know you've gone wrong. You don't go any further until you fix that. Disagreements are, hold on, oops, sorry about that. Disagreements are easily resolved because we're looking at numbers on things. So if people have got a difference of opinion, you can say, well, why do you think this and why do you think that? And defer to the data. The data will tell you who's right. Only those people who know about the piece that you're working on need to be involved. You've got to be a bit careful about that, of course, because sometimes people don't really know what they think they know. But you don't have to involve very wide groups of stakeholders, except at various points in the process to kind of show them how you're getting on. It takes far less working time, far less elapsed time, and much, much lower cost. Now the further benefits are that this is a reliable process. If you follow the discipline, which is the platform of our method, you should get the same result whoever does the work. The problem with the causal loop diagramming start point is that the result you get depends on who facilitates the work. That should not be the case for a professional method. You should get the same result whoever does the work. Being a reliable process that is codified, it's easily learned, and what that means is that our young professionals can get out and make a real impact early on. They can show up with quite senior people and say, I can help you solve that problem, and go through a reliable process and actually solve the problem. So I said that this is, I've just taken you through a very simple example. Let me quickly show you a more complex one. And I'll tell you in a minute how long this took. This was done for the CEO of this company. Sorry, it's not the company is not Solving FSO. That's a consulting firm I've worked with. So please ignore Solving FSO at the bottom of that slide. The company is called NMC, and they make equipment to clean the ballast water of ships. There are various technologies involved. There's a kind of mechanical way of removing organisms from ballast water. There's chlorine treatment like you use in your swimming pool, or there is ultraviolet and filtration solution, which is what NMC offers. Now, the International Marine Organization is about to regulate requiring all ships to have equipment to do this cleaning of their ballast water, and those regulations mean that every ship will have to be fitted the next time they come in for an overhaul, which basically means all 57,000 vessels worldwide will have to have this equipment installed over the next 5 years. There are some 35 approved systems from 50 or more suppliers, right away from small teams right up to big corporations like Siemens. Now, when that boom is over in the refit world, the only remaining sales will be for new ships that get built. So the challenge is, how do we capture ship operators' decisions on which system to deploy, achieve rapid installation in their fleets, and capture installations in new vessels? That's what my friend who Hubert Schell said that MMC is worried about, and that's why he wanted this model built. It's complicated. We've got very large numbers of companies of lots of different sizes. We've got very wide ranges of equipment size and price, with different market potential for different units in the market, different segments of the market. No supplier can successfully offer all necessary products, so you've got to focus. So these are the questions that my friend is worried about: which sizes of vessels to target, how many models of systems to develop, how much effort to win the agents. You can go to agents who will sell for you to the ship operators. When they've opened the door for you, you've got your own salespeople who can go in and try to win new customers, but then they've also got to go back to existing ship owners and try to get repeat sales from them. you've got to decide what prices to charge on which systems to which sectors, how many engineers to employ. Production's outsourced, we don't need to worry about that, but we've still got to manage the production of units and the commissioning and installation of the units in the ships. How much investment is needed? What profits will arise? How will cash flow grow? So the guy needs a business plan from first principles. And all of those questions arise continually. Every month that goes by, new information comes in that tells you how the business is performing and tells you how the market and competition is developing. And this is a disguised version of the working model that came out of this process. In this picture, months 1 to 21 are the history of the business, months 22 to 60 are the objectives we want to see come out. Across the top, we've got the number of models that we're going to develop. Red ones are not yet approved, and the blue ones are approved models. We've got growth in customers, we've got growth in sales, we've got the installed base, and the bottom right is the cash flow. This again is a working model. You can go and play with that on your own machine. You'll have to refer back to this explanation to see what it does. And the result of following the process I just explained is this model structure. And the model structure has got R&D at the top, which is generating the equipment models and getting those models approved. It's got agents who are captured if we send some of our salespeople to try and sign up those agents. We've got the ship owner customers and the sales to those customers. So we've got prospects being won by agents, and we've got customers being contracted to us by our own sales effort. And the purple section at the bottom is tracking the projects through from signing the sale, the equipment gets built, the equipment gets delivered, the equipment gets installed, and on the right-hand side of the purple section is the install base of equipment. On the right-hand side is a simple income statement. We get revenue from the value of the equipment that we sell multiplied by the units. There's a cost of goods to give us a gross profit, and there are operating costs with the sales force and the engineers. And you take all those costs away from those revenues and gross profit, and that gives you the performance summary in the green area at the top right. So that's an example of doing a slightly bigger project. But I constructed that with the CEO during two-hour Skype calls, and the CEO spent another 2 to 3 days getting the data and just checking that it worked, and I spent another half day maybe tidying the model up. The elapsed time for that project was 2 weeks from start to end, and Hervard is now using that model for planning his priorities and for seeking broad support for the investments that he wants. So that's really, I think, all I want to say. There are a few more slides that explain each of those segments in detail, but I don't think we need to go into that. You can see them if you go and play with the model. What I'd rather do is kind of stop here. Nearly stopped. Hold on. And really open it up to to questions.
Good evening, Professor. Do you hear me?
Just about, yes.
Okay, I'll try to talk longer. I'd like to ask you, in the first model, you developed the stock drivers with the CEO, the people you were working with, but sometimes managers overlook to some factors that could be stock drivers. How would you recognize this in the model, or is there any technique to identify this so the model could work and contribute reliably the results?
Can I just check I heard the question correctly? Are you asking about how to do this when there is a wider group of people who need to be involved, not just the CEO? Is that the question?
Yes, not just about who should be involved, but how to avoid that the people that is involved could overlook some of the factors that affect stock drivers.
Oh, okay. Yeah. Well. In this particular case, it wasn't just the CEO involved. We had the finance guy and the head of business development involved as well. So I would always involve the team who own the problem. Of course, if it's a bigger organisation, it's a bigger problem, then you may have to conduct separate parts of the process with the product development team or with the HR team or with the operations team, depending on how far you need to go and how complex the issue is. But on the issue of have they missed anything, you know whether people have missed anything in the explanation for the current situation because the lines match. You know, the lines that they give you that show the data on the performance that they're trying to explain is matched by the lines that the model generates. And if that's not true, then either there's a mistake in the model somewhere, and that's the beauty of this. Any mistake in the model instantly shows up because the lines go in different directions, or you've missed something out. So you can see exactly where in the structure that error starts from, and you say, okay, so this line here for the customer win rate doesn't seem to be matching what we think should be going on. What are we missing here? There must be something else happening. Now, of course, that isn't going to protect you against the possibility that something else may happen at points in the future. So in this case, for example, the engineering company is very likely to see new competitors coming in with equipment very similar to theirs. So we say, well, where in the system could something else impact on this? What could it be, and how serious could its impact be? And then we test that out in the model, looking forward, rather than expecting to find it proven by information from the past. I hope that answered the question.
Okay, thank you.
Hi, Professor. This is João Arantes from Unicast. I have a question to you about this Agile development. I have been working with software development for a long time. It looks like the first model that people are used to work with is similar to the waterfall method that the people design and analyze and codify, etc., and get the feedback by the end of the project. And the Agile methods that are used in software development are kind of similar to that, about getting involvement of the clients and developing by prototyping, evolutionary prototyping. Can you tell me, like, you do have an inspiration based on software engineering, or How did you get to this?
Oh, no, I have no background in software engineering at all, but I have an awful lot of software engineers or ex-software engineers who take my courses, and I do ask them, if there's anything like right, and they say, well, it's right enough to look a little bit like the way in which software used to be developed, but is not so much done so now. I should add, by the way, that the experienced practitioners who I work with, SD practitioners I mean, some of them say, well, we don't do that. We don't do either of those things. They do a third thing, which is that they have a library of models that they've used many, many times before. And what they do, they take those models and adapt them to the new situation that they come up against. And we've got plenty of standard models in our field, which we should be making much stronger use of, I think. And I think there are more of them out there to go for. There are standard models about infection, the spread of infection. There are standard models about staff development. There are standard models about project management, which are rather widely used. I happen to do almost all my work in the corporate sector, so what I'm discovering is that there are highly replicable models for different kinds of firms. I've just been working with a large law firm, and the large law firm's model structure is very, very similar to any other large law firm. And also very similar to architect firms, to consulting firms, and to accounting firms. But so you don't have to do this if the problem you're being asked to address is a problem that has been successfully modelled many, many times before. You may still need to do some of it. In the law firm case, they're trying to understand the impact of codifying their knowledge about the sectors they work in on the ability of their business to do good work and win clients. Now, because that's novel, that's new, that's not something they've done before, we've still got to use this process to extend the core model of a law firm. But we're starting from something that we already know works. But rather like SAP does, of course. If you go along to SAP and ask an enterprise resource planning system, they don't kind of sit down and scratch their heads and try and figure it out from scratch. They pull out the one they've done for 10 or 20 or 50 clients previously. They say, well, your retail business is very like the other 10 retail businesses, and here is our SAP solution for your kind of business. We'll adapt it, of course, which we'll charge you lots of money for that. But we won't try and invent a solution from first principles every time.
Professor Ward, have you published your work, your research about Agile model? And I saw in your presentation that there are some links to the models. Are they available on the internet?
Yeah, those links take you to a live web-based model that you can use on any browser, as long as it's later than Internet Explorer 9. It should work. It should work on Safari, Chrome, Firefox, whatever. If it doesn't, let me know. I think the first few as well. The models themselves include links to short videos that explain how to use the models. And your first question about has this been published? Well, I submitted a paper to the Delft conference, and to be honest, I haven't got a whole lot more to say about it than is in that paper. I don't think it deserves a book. I know authors in the business field manage to publish 200-page books based on one very simple idea, but I don't think there's really a need to do that in this case.
Professor Warren, we thank you very much for your presentation. It was very interesting, and it was a pleasure to have you with us today. And this is our problem.
Thank you very much for your time this afternoon. I hope the rest of your conference is successful.